Hey, everybody. Welcome to the podcast. Thank you for joining me. Today is October 15th, and here we are approaching Halloween, the holiday season. Everything's coming up very quickly. The leaves are changing, the temperatures are changing, and maybe the market's changing. And if you're just coming home from work, you didn't really watch the market today, that was probably best because it was a gut-wrenching day if you own any type of stocks for several reasons. Number one, the Dow Jones kind of gapped down this morning. I'll take you through the day here. So this is a picture of the Dow Jones, and you can see we started off pretty bad and got worse and worse and worse. We were down about 370 at one point. They really almost looked like a flash crash, just things going straight down. And then it reversed, pretty strong reversal, and drifted lower all day until we got down here where the Dow was down. At one point, I think it was down somewhere around 450 points. Finished the day down 174. I think what's really interesting about this day is if you look at the Russell 2000, it actually finished up on the day. And this is the third or fourth day in a row that we're seeing the Russell start to actually lead. So even though last few days it may have been down, it actually is leading. Today it was up a little bit today. So not a bad reversal for the Russell 2000. But again, the bigger picture here is you've got global growth looking like it's slowing. Some of the data in the U.S. looked like it was slowing with the bad retail sales numbers. And on top of that, you have Ebola looking like it potentially is getting out of control, and the CDC not really knowing what they're doing. They're not really exuding confidence. So, and then ISIS on top of that. So you have all those things happening, and oil plunging. It feels like a deflationary environment, and the market to me looks like as if it's begging for QE4, right? That's what it's begging for. That's what it looks like, is that, hey, throw us our life vest here because we know that every time the market's gone down, you guys have intervened. You've thrown us a life vest in the form of some type of quantitative easing, and the markets have bounced back. Investors aren't getting that right now. And so you're having this period where people are literally saying, I don't know what to do, because what if global growth continues to slow? What's happening, I think, is that the U.S. is still in much better shape than the rest of the world and continues to be, and getting even better. Look what's happening. We've got the oil production, okay? We have a little bit better growth, although tepid. We have our unemployment going in the right direction, and we have our dollar going up. So the U.S. consumer, is actually getting this benefit right now of lower oil and gasoline prices. And so over the next few months, I think potentially, could this just be a soft patch? You know, that's what the bulls are saying, is that they think it's a soft patch. Everything will get much stronger in the fourth quarter. We'll see. Some of the earnings coming out look pretty good so far. And again, it hasn't mattered, though. Alcoa came out with good earnings. The stock got hit. So it hasn't mattered so far. But as this continues to go on, let's see if it does matter. But it hasn't mattered so far. It has not been an earnings story. It's been more about this whole global growth situation. But looking at the technicals here, the S&P 500 definitely broke. You can see that. It had some moving averages crossing, et cetera, and we broke the 200-day moving average. So not only did we break the 50 and the 100, but the red line here is the 200-day moving average. So that is broken. Now, here's the thing. These types of events are extremely scary and panicky. And depending on who you are, we've talked about this on the radio show this past week, and depending on who you are and what you're trying to accomplish, this is either good for you or it's bad for you. If you're somebody that needs the money in the next year or two, you shouldn't be in high volatility stocks. You should probably not even be in stocks, period, because you're going to be forced to liquidate at lower prices. If, on the other hand, you are not using this money and won't be using this money for the next few years, 5, 10, 15, 20 years, or you're adding to your portfolio, then you use this opportunity to buy, because what's happening right now is you are seeing forced selling, and it always happens this way. People that were used to borrowing at very low rates to buy stocks are now getting margin calls. As they get margin calls, they are forced to sell. Mutual fund managers are getting redemption requests, right? So if you're a mutual fund manager, you're sitting there trying to manage a portfolio, and you get all these tickets on your desk saying you need to raise $3 million because all these people want their money. So you have to go sell stocks to meet the redemption request. That is another area of forced selling. And then you just have the panicky people who sell at the bottom and buy at the top. And so, that is not the time to do it. Now, I will say, look, this right now, and we're going to go through the volatility index. We'll look at gold, interest rates, et cetera. But right now, we said that there is a test, and we've been talking about this the last several weeks and months, that until proven guilty, the market was innocent, because every time it had one of these 4 to 5% pullbacks, it bounced. It didn't do that this time. So it has failed the test. Okay? This is a failure. It has failed that. However, here's what I'm watching. You're looking for an intraday reversal. Today might have been it. We'll see. But what you're looking for is, we know we're getting these 90% down days. Everybody's in. All these stocks are just going straight down. And, these charts look like, kind of joke around, not that this is joking matter, but what happens is when this starts falling, this chart almost looks like it's going to start going backwards in time. It's going down so straight. And when you see a combination of, this is the combination of this type of free fall, and you see volume picking up, and let me switch to the spiders because you can really see it on there. Look at the volume in the spiders, which is the S&P 500. Look at this volume down here, 364 million. The average recently has been somewhere right around 100 million. So we traded almost 4 times what the 50-day moving average is of volume. That shows you a lot of shares changing, a lot of uncertainty. This is what happens during capitulation and also during short-term bottoms. And I'm using the word short-term bottoms because I don't know if this turns out to be a V and up we go. I don't think that is going to be the case. I think we could churn for a while, but in the very short run, what I am looking for is, if you wanted to sell up here and you didn't, you get the bounce, and if the bounce comes in and we start hitting these moving averages and it rolls over here, that's your time to sell. So if you have the patience, your time to sell is maybe when we get back up into these levels, not when everybody else is forced to sell down here. You're not forced to sell. As much fun as it's not going through these periods, and it's very painful and scary, you don't sell on these types of days. You can go back in history and look. And actually today, for our clients who were underinvested or had cash sitting there, we actually took advantage of some of these prices a day and bought some things. That doesn't mean necessarily we're turning bullish and putting a line in the sand. That's just saying, look, even as a trade, we could make some money here. One of the places that we bought in the last few days, and a couple days early, was the oil, gas, and exploration companies. These E&P companies have been just killed. If you take a look at this, these stocks are down from July. They got down to as low as 37% drop. And if you go back and look, remember, these things were going straight up. They were a no-lose proposition. And then oil starts falling, and now what you worry about, where's that tipping point? Is it $75 a barrel where these projects get turned off and delayed? I don't know what that number is, but I think it has to do with going below 80 and then staying there for a while. That's the other key. But look at the volume picking up here on some of these. The volume is picked up rather dramatically. And again, what I like to look for is some of these charts that are going straight down, as if they're going out of business, and the volume's going straight up. Those are generally really good buys. I can't tell you if this buy is going to be something that is going to be a long-term investment or not. I don't think so, but I am looking for a trade, and you do see that we had, I'll zoom in a little bit, kind of this engulfing where we made new lows, and we actually came back and beat close to the highs yesterday. So not technically an engulfing pattern, but if this leads to something like this and then it starts to roll over, look, from the bottom here to up here, that's a 25% move, guys. This is a huge move. So it doesn't take much for these things to ramp up for a trade. So we went in and bought that. We actually bought it a couple days ago. So we bought it, and have had a couple of days of losses here. But you had a nice big reversal today. It was up about 4% on the day after being down this morning. So that was one area that I'm looking at. Also, what was interesting was take a look at the 1-minute picture of TLT, a big gap open in Treasury bonds, and then pretty much, for the most part, straight down from there. Okay, now we did get it down. And then obviously when the market was down about, Dow was down about 450 points, people were piling back into Treasury, still not at the high of the day. And then it sold off almost to the end of the close and almost is up 75 basis points, but just dramatic movements in the bond market. So again, you had Jeffrey Gundlach yesterday discussing that he thinks there's a bottom in for rates. And I guess he was at least one day early because we didn't see that bottom. But this was a big, big move in the bond market. So again, there's this question whether or not another form of QE is coming. You had a Fisher on today saying it's premature to talk about another round of QE, but they are talking about it, right? And, they have shown that they will do some form of QE. The hard thing is, are they really going to do QE when interest rates are at 2.1%? How much lower can they push them? So, but you did have a lot of reversals in a lot of stocks today. Obviously, most of the beaten up ones reversed, but it's too early to say, hey, this thing is clear sailing ahead. But again, if you're opportunistic, you can take advantage of the sell-off. And this is the way you do the math, guys. You look at this and say, hey, I've got 100% cash. I've been scared of the market. Well, a lot of stocks are down about 10% on average. So if you think the market's going to drop 30%, it's already a third of the way down. So why not invest part of that money? That's the way you have to think about that if, again, this is longer-term money. Now, if we look at we already looked at interest rates. Take a look at the volatility index. Again, a big reversal. This thing was up over at 31 today. It finished at 24. This fear that we're seeing and the how fast it's gone up is the most fear we've seen going back to the financial crisis. This is more fearful than 2011 when we had a 20% drop in stocks. And this is what I was a little concerned about, is because we had such a smooth ride in the S&P 500 that people were lulled to sleep. And if we were going to get a sell-off, it wasn't just going to trickle down. It was going to escalate rather quickly because there's a lot of stop losses in place at that trend line, and that's what's happening. But we could also get that V, and then that's when you would want to sell. So watch that carefully. But again, also watch some of these beaten up areas. But they're, for investments, there are a lot of good stocks out there that are just great deals right now. And, but they may be the most volatile ones. So we're definitely may not be out of the woods yet. I don't think we are. But this pop that we're seeing in late in the day, hopefully this will lead to another couple of days. And then if you want to get out, you can reduce your exposure at that point. But the way these bottoms are made are by intraday reversals, just like this, high volume. But what we need to see is 2 or 3 more days of just the opposite, where your whole screen is green and everybody's rushing in and saying, I should have bought that dip. I should have bought that dip. That's what would tell me it's an actual reversal. If we just get up 70, up 60 on the Dow, not a lot of volume, then I will be looking to get even more defensive as it's rallying, as opposed to looking to buy more. Okay? All right, that's all I've got for today, and we will talk to you soon. By the way, the picture oil, this is through yesterday. Oil actually, I think, was close to being flat today. Oil's just been getting obliterated, and this thing, we think it could go a little lower, could be in the high 70s before it's all said and done. But again, it's oversold, as is the dollar is overbought.